Something fundamental shifted in the silver market recently. And if you hold silver, or if you've been considering it, what I'm about to share with you demands your full attention. I'm not here to tell you that silver will make you rich overnight. I'm not here with predictions about specific prices or timelines. What I am here to do is walk you through what's actually happening, why it matters, and how you should be thinking about this moment. This is not about excitement. This is about understanding. Because in finance, the difference between those who build lasting wealth and those who get swept away by market waves comes down to one thing: knowing what you're looking at and responding with discipline rather than emotion. Over the next 25 minutes, we're going to examine silver from every angle that matters. The historical patterns, the current signals, the psychology that trips up most investors, and the strategic frameworks you need, whether you already own silver or you're deciding whether now is your moment to act. Let me be clear from the start. I have no agenda here except education, no product to sell you, no commission to earn, just one professional to another, cutting through the noise to focus on what's real. So let's begin where we must, with the facts. Silver has moved, not just a little, not just noise, the kind of move that makes seasoned investors pause and reassess. But here's what separates professionals from amateurs. Amateurs see a big move and ask, how high will it go? Professionals see a big move and ask, what does this tell me about the underlying market structure? That's the question we're answering today. The silver market has been sending signals, multiple signals actually. Price action that suggests something more than routine fluctuation, volume patterns that indicate genuine repositioning, market structure that reveals stress points and potential inflection points, and underneath it all, macroeconomic conditions that create the kind of environment where precious metals historically shift from stable to dynamic. You need to understand something fundamental about silver. It sits at the intersection of two worlds. It's both a monetary metal and an industrial commodity. This dual nature makes it uniquely responsive to forces that would only partially affect gold or copper or any single-purpose asset. When monetary conditions change, silver responds. When industrial demand shifts, silver responds. When both happen simultaneously, which is where we are now, silver can move in ways that shock those who aren't paying attention. Let's talk about history. Not because the past predicts the future, but because patterns of cause and effect tend to repeat when similar conditions emerge. Silver has experienced 3 major bull markets in the modern era. Each one taught us something critical about how this market operates. The first was the 1970s. Inflation was ravaging currencies. Confidence in central banks was collapsing. Nixon had closed the gold window. The entire monetary system was being rewritten in real time. Silver went from roughly $1.50 to $50 in less than a decade. Was that sustainable? No. Did it eventually correct? Absolutely. But the people who understood what was driving that move, who positioned themselves early and managed their risk, those people fundamentally changed their financial lives. The second was the late 2000s and early 2010s. The financial crisis had destroyed trust in the banking system. Central banks were printing money at unprecedented scales. Sovereign debt was exploding. Silver climbed from under $10 to nearly $50 again. Same pattern. Monetary crisis, loss of confidence, massive intervention by central banks, and silver responding exactly as economic theory would predict. The third major move was 2020 to 2021. Pandemic uncertainty, trillions in stimulus, supply chains breaking. Silver doubled from its lows. Now, I'm showing you this history not to say we're about to see $50 silver. I'm showing you this to reveal the pattern of conditions that precede major silver moves. Each time, the same ingredients were present: monetary expansion, currency concerns, crisis of confidence in traditional financial systems, industrial demand meeting constrained supply, and a market structure that allowed for rapid price discovery once momentum began. Look at where we are today. What do you see? The global financial system is under stress, not the kind of stress that creates headlines every day, but the kind that builds slowly, accumulates, and eventually demands resolution. Sovereign debt levels across developed nations are at peacetime records. The United States, Europe, Japan, all carrying debt to GDP ratios that would have been considered catastrophic a generation ago. Central banks spent the last 15 years expanding their balance sheets to dimensions that were previously unimaginable. The Federal Reserve's balance sheet went from under $1 trillion to over $8 trillion at its peak. The European Central Bank, the Bank of Japan, all following similar paths. And now we face a fundamental question. How does this resolve? You can't print your way out of a debt crisis forever. Eventually, either the debt gets inflated away, which means currency devaluation, or spending gets cut drastically, which means economic pain and likely more money printing to cushion the blow. Either path is constructive for hard assets. Either path creates the kind of environment where investors seek stores of value outside the traditional system. Then there's the industrial side. Silver is essential to the energy transition. Solar panels require significant silver content. Electric vehicles use more silver than traditional cars. 5G infrastructure, medical devices, water purification, electronics manufacturing. The industrial demand base for silver is not only stable, it's growing. Meanwhile, primary silver mine production has been essentially flat for years. Most silver comes as a byproduct of copper, lead, and zinc mining. When those operations slow, silver supply tightens, regardless of silver's price. This is the setup. Monetary pressure from one side, industrial demand from another, supply constraints underlying both, and a market that's relatively small compared to gold, meaning it takes less capital to move. Here's where most people go wrong. They see these fundamentals, they get excited, and they make emotional decisions that destroy their results. Let me walk you through what actually happens in a silver market cycle. Because if you understand the psychology, you can position yourself to benefit rather than become a victim. Phase 1 is accumulation. This is where smart money enters quietly. Prices are boring. Nobody's talking about silver. The fundamentals are improving, but slowly, and most investors aren't paying attention. Volume is relatively low. The move up is gradual. If you're watching carefully, you can see it, but most people aren't watching. Phase 2 is awareness. Prices start moving more noticeably. Financial media begins covering it. More investors start researching. Volume increases. The move accelerates. This is when early individual investors typically enter. Still rational, still driven by fundamentals, but starting to attract momentum. Phase 3 is enthusiasm. Now everyone's talking about it. Prices are up significantly from the lows. Stories of gains are spreading. FOMO begins to build. People who missed the first move are determined not to miss more. Leverage increases. Speculation overwhelms investment. This is where professionals start scaling out. Phase 4 is euphoria. Price moves become parabolic. Predictions get absurd. Everyone has a story about someone who made money. Risk management goes out the window. People are taking out loans to buy silver. The fundamentals no longer matter because it's different this time. This is where professionals have exited. Phase 5 is the top, followed by the inevitable correction. It doesn't matter how strong the fundamentals were. When price gets too far ahead of value, when leverage is extreme, when the last buyer has bought, there's nowhere to go but down. The correction is often as violent as the rise. People who bought at the top with leverage get destroyed. Confidence evaporates. The asset gets declared dead, even though the fundamentals haven't changed. And then the cycle begins again. Now, here's the critical question. Where are we in this cycle right now? Based on price action, volume patterns, mainstream attention levels, and funding rates in derivative markets, we appear to be somewhere between Phase 1 and Phase 2. Silver has moved. It's gotten attention. But we're not yet at the point where your relatives are asking you about it. We're not seeing parabolic price action. Leverage hasn't gone extreme. The move, while significant, still appears to be driven primarily by fundamental repositioning rather than pure speculation. This matters enormously. If we're in early Phase 2, there's typically substantial room for the trend to develop. Not guaranteed, nothing in markets is guaranteed, but probable based on historical pattern recognition. But that's also when discipline becomes critical. Because the transition from Phase 2 to Phase 3 happens faster than most expect. And once you're in Phase 3, the timer is running. Your job as an investor is not to predict exactly where we are. Your job is to have a framework that works regardless of where we are. That means position sizing that lets you sleep at night. That means having clear rules for when you add to positions and when you reduce. That means understanding your own risk tolerance and psychology well enough that you can execute your plan when emotions are screaming at you to do something else. Let's get specific about what's happening on the supply and demand side, because this is where theoretical economics meets practical reality. On the supply side, we have constraints that aren't easily solved. Primary silver mines are relatively rare. Most silver, as I mentioned, comes as a byproduct. This means silver supply is not particularly responsive to silver prices. If silver doubles, a copper mine doesn't suddenly produce more copper just to get the silver byproduct. They're running their operation based on copper economics. The silver is almost incidental. This creates an unusual dynamic. In most commodity markets, rising prices incentivize production, which eventually brings prices back down. In silver, that feedback loop is weak and delayed. Meanwhile, above-ground silver inventories have been declining, not catastrophically, but steadily. Years of industrial consumption exceeding mine supply means the surplus that was accumulated decades ago is being drawn down. Exchange inventories, the silver held in COMEX warehouses and other trading venues, have shown periods of significant decline. When these inventories drop while prices are rising, it suggests genuine tightness rather than just speculative positioning. On the demand side, we have both structural and cyclical factors. Structurally, the green energy transition is real, whatever your political views on climate change. Governments worldwide are mandating increases in renewable energy capacity. Solar is the most economically viable option for most applications, and solar panels require silver for the conductive paste in photovoltaic cells. This isn't demand that will peak next year. This is demand that's built into infrastructure plans for decades. Add to that the increasing silver content in electronics, medical applications, and emerging technologies. Each individual application might be small, but collectively they create a rising baseline of industrial demand that's very difficult to substitute away from. Then there's investment demand. This is more volatile, more sentiment-driven, but potentially more explosive. When investors decide they want silver as a monetary hedge or inflation protection, the amounts of capital involved can overwhelm the physical market quickly. Silver's total above-ground supply is worth perhaps $50 billion at current prices. That sounds like a lot until you realize that amount of money moves through financial markets in hours, not years. We need to talk directly about currency debasement because this is perhaps the most important long-term driver of precious metals prices, and it's one most people don't fully understand. Every major currency in the world is being debased. Not might be, is being right now. This is not conspiracy theory. This is explicit monetary policy. When a central bank expands its balance sheet, it's creating new currency units. When a government runs a deficit, it's spending money into existence that must eventually be financed through some combination of taxation, borrowing, or inflation. The mathematics are straightforward. If the supply of currency units increases faster than the supply of goods and services, each currency unit becomes less valuable in real terms. This is not complicated economics. This is arithmetic. Now, governments and central banks will tell you this is necessary. They'll tell you it's temporary. They'll tell you it's under control. Maybe they're right. Maybe this time is different. But as an investor, your job is not to trust reassurances. Your job is to protect your purchasing power. Throughout history, when currencies are debased significantly, hard assets rise in nominal terms. Not because the assets become more valuable, because the measuring stick, the currency, becomes less valuable. If you have 100 ounces of silver today and currency debasement continues, you might find in 5 years that those 100 ounces can be sold for twice as many currency units. But have you really gained? Or have you just preserved your purchasing power while those holding cash lost half of theirs? This is the framework that sophisticated investors use. They're not asking, will silver go up? They're asking, how do I preserve purchasing power in an environment of currency debasement? Silver, like gold, has no counterparty risk once you own it physically. It can't be printed. It can't be defaulted on. It doesn't depend on anyone's promise. It simply exists. In stable monetary times, this property is interesting but not particularly valuable. In unstable monetary times, this property becomes worth paying for. We are living through the largest monetary experiment in human history. The outcome is unknowable, but the risk is very knowable, and silver is one of the oldest, most tested hedges against exactly this type of risk. If you already own silver, physical or paper, you need a framework for this environment. First, do not get emotional about short-term price moves. Silver volatility is legendary. You can see 20 or 30% swings in a matter of weeks. These moves feel significant when you're watching your account value, but they're noise compared to the long-term trend. Your mindset needs to be that of someone holding insurance. You don't check your homeowner's insurance daily to see if it's gained value. You hold it because you understand the risk it protects against. If you own silver as a monetary hedge, as portfolio insurance, then short-term price fluctuations are irrelevant. You're holding it because you understand the macroeconomic risks we discussed, and you want protection if those risks materialize. However, and this is critical, you need to have rules for position management. If silver has appreciated significantly and now represents a much larger percentage of your portfolio than intended, you need to decide, are you going to rebalance, taking some profits to maintain your target allocation? Or are you going to let it run, accepting higher concentration risk? There's no universally correct answer. It depends on your situation, your risk tolerance, your conviction about the current macro environment. But you must have a framework. You must have rules you've decided on in advance, when you're calm and rational, so that you can execute them even when markets are wild and your emotions are engaged. One approach is the third strategy. Divide your position mentally into 3 parts. The first third is your core holding, which you don't trade. It's insurance, and it stays in place regardless of price action. The second third is your tactical position, which you might add to or reduce based on market conditions and valuation. The third is your opportunistic portion, which you actively trade to take advantage of volatility. This framework lets you participate in upside while maintaining discipline and protecting against catastrophic decision-making. Another critical point: if you own paper silver, ETFs, or futures or mining stocks, understand the difference between these and physical metal. Paper silver gives you price exposure, but not the fundamental property of zero counterparty risk. In a true monetary crisis, that difference could matter enormously. I'm not saying you shouldn't own paper silver. It has advantages: liquidity, ease of trading, no storage concerns. But know what you own and why. If you're truly hedging against systemic risk, some physical exposure makes sense. If you're trading price movements, paper is likely more practical. Don't confuse the two strategies. If you don't currently own silver but you're considering it, your situation is different and requires a different framework. The first question is not, should I buy silver? The first question is, what role would silver play in my overall financial plan? Are you looking for portfolio diversification, inflation protection, monetary crisis insurance, speculative exposure to a potential bull market? Your answer determines everything else: how much to allocate, what form to own it in, how to time your entry. If you're looking at silver as portfolio diversification and inflation protection, the academic research suggests somewhere between 5 and 15% of a portfolio for total precious metals exposure. Some would argue more, some less, but that range represents a stake large enough to matter if precious metals perform, but not so large that you're taking undue concentration risk. Within that allocation, you'd likely want mostly gold, with silver as a smaller complement. Why? Because gold is the primary monetary metal, the one central banks hold, the one with the deepest liquidity. Silver is more volatile, more speculative, but also potentially higher returning if conditions align. Perhaps a 70-30 or 60-40 gold to silver ratio makes sense for most people in this scenario. Now, if you're convinced we're early in a major silver bull market and you want more aggressive exposure, you might tilt that ratio towards silver or even go entirely into silver. But understand that you're making a tactical bet, not a strategic allocation. You're increasing risk for increased potential return. Nothing wrong with that, as long as it's a conscious decision and you're prepared for the volatility that comes with it. Regarding timing, here's the reality. Trying to time the perfect entry in silver is a fool's errand. The market is too volatile, too prone to false starts and sudden pullbacks. The better approach is systematic accumulation. Decide your target allocation, then build it over time. Maybe over 3 to 6 months, maybe longer. Dollar cost averaging into silver eliminates the risk of going all in right before correction, while ensuring you're building exposure if the trend continues. Yes, if silver rockets higher immediately, you'll miss some gains by not going all in today. But if it pulls back 20% next month, you'll be grateful you saved capital to buy more at lower prices. Systematic, disciplined, emotionally neutral. That's the professional approach. Regarding the form of ownership, you have several options. Physical silver, either coins or bars. ETFs like SLV, futures contracts, mining stocks, closed-end funds. Physical has the advantage of zero counterparty risk and the satisfaction of actually owning the metal. Disadvantages are storage, insurance, liquidity constraints, and dealing with premiums and spreads. ETFs are liquid and easy, but carry counterparty risk and tracking error. You don't own the metal, you own a claim on the metal. For most investors, this is fine. But understand the distinction. Mining stocks are leveraged plays on silver prices. When silver rises, miners typically rise more, but they also fall more, and they carry company-specific risks that have nothing to do with silver prices: management execution, operational problems, jurisdictional issues. For most investors, a combination makes sense: some physical for the security and tangibility, some ETF for easy liquidity, perhaps some mining exposure for leverage if you have the risk, tolerance, and knowledge to evaluate companies. Let's talk about risk, because this is where most silver investors eventually fail. Silver is volatile, deeply, shockingly volatile. You can experience 30 or 40% drawdowns even in a bull market. If you're not prepared for this psychologically, if you don't have the risk management tools in place, you will sell at the worst possible time. First principle: never invest more than you can afford to lose. This sounds basic, but violation of this principle destroys more investors than any other mistake. If you need the money for living expenses, if you'll be in financial trouble if silver drops 50%, you have too much exposure. Your silver allocation should be such that even if it went to zero, which it won't, but if it did, your overall financial situation would remain intact. You'd be disappointed, but not devastated. Second principle: understand and limit your use of leverage. Some investors buy silver on margin or use futures contracts with significant leverage. This can amplify gains dramatically. It can also wipe you out. Leverage turns volatility into an existential threat. A 30% drawdown with no leverage is painful but survivable. A 30% drawdown with 3-to-1 leverage might force liquidation of your entire position at the worst possible price. If you're going to use leverage at all, and I generally don't recommend it for most investors, it should be modest, and you should have a clear risk management plan, including stop losses and position sizing that prevents catastrophic loss. Third principle: diversification remains important even within precious metals. Don't put everything into silver. Don't put everything into one mining stock. Spread your exposure across different forms, different companies if you're in the equity space, different jurisdictions if you're buying physical. Fourth principle, have an exit plan. Not because you'll necessarily execute it, but because having one prevents panic selling. Know in advance under what conditions you would reduce or exit your position. Is it a certain price level, a change in the fundamental story, a portfolio rebalancing trigger? Write it down, make it concrete. Then you have a rational framework to refer to when emotions are high. Now, we need to address the specific behavioral mistakes that destroy silver investors. These are documented, repeated patterns. If you can avoid these, you're ahead of 90% of market participants. Mistake 1, chasing parabolic moves. When silver is up 10% in a week, 30% in a month, that's when most retail investors pile in. They're buying enthusiasm rather than value. They're guaranteeing they enter near a local top. The time to buy is when silver is boring, when nobody cares, when the fundamentals are building, but the price hasn't moved yet. Not when it's already gone vertical. Over-leveraging. We discussed this, but it bears repeating. Leverage in volatile assets is a recipe for forced liquidation at exactly the wrong time. If you can't own silver without leverage, you should own less silver, letting profits run into losses. You bought silver at 20, it runs to 30. You're up 50%. You didn't take any profits. Then it drops to 18. Now you're underwater. This is a psychological disaster that often leads to selling at the bottom. Having some rules about taking partial profits at predetermined levels protects you from this trap. Panic selling during corrections. Silver will have sharp pullbacks even in a bull market. If you sell during these because you're frightened, you lock in losses and then miss the recovery. This is why position sizing is critical. If your position is small enough that a correction doesn't threaten your financial security, you can hold through volatility. Trusting price predictions. Anyone who tells you silver will definitely hit $50 by next year or $100 by 2030 is either naive or selling you something. Nobody knows. The future is probabilistic, not deterministic. Make decisions based on risk-reward ratios and portfolio theory, not on someone's confident prediction. Ignoring taxes and transaction costs. In many jurisdictions, silver sales trigger capital gains taxes. Physical silver has buy-sell spreads that can be significant. Trading costs, storage costs, insurance costs. These eat into returns. Factor them into your decision-making. Mistake 7, betting the farm on mining stocks. Junior mining stocks can go to zero. Even quality producers can underperform for company-specific reasons. If you want mining exposure, diversify across multiple companies and be prepared for individual holdings to fail. Mistake 8, confusing nominal gains with real returns. If silver doubles, but your currency has been cut in half through inflation, you haven't made money. You've just preserved purchasing power. This isn't bad. It's actually good. But don't confuse preservation with profit. Mistake 9, ignoring opportunity cost. Money in silver is money not in stocks, real estate, business investment, or other opportunities. Silver needs to outperform these alternatives on a risk-adjusted basis to be worth holding. Don't get so fixated on silver that you miss other opportunities. Mistake 10, becoming an ideologue. Some silver investors turn their position into an identity. They're silver bugs who can only see bullish scenarios. This is dangerous. Markets don't care about your beliefs. Stay objective. Be willing to change your mind if the facts change. We need to address the silver versus gold question directly because it influences strategy. Gold is the senior monetary metal. It's what central banks hold. It's what moves when currency confidence wavers. It's more stable, more liquid, more universally recognized as a store of value. Silver is more volatile, more industrial, more speculative. It tends to lag gold early in precious metals bull markets, then outperform later as momentum builds. The historical gold-silver ratio, the price of gold divided by the price of silver, averages around 60 over very long time periods, though it's fluctuated from 15 to over 100 in modern times. When the ratio is high, silver is historically cheap relative to gold. When it's low, silver is relatively expensive. Some investors use this ratio to make tactical shifts between the two metals. Currently, the ratio is, note, actual current ratio would be checked with current data, but for the script, we'll address this conceptually. If the ratio is elevated, it suggests silver has more catch-up potential. If it's already compressed, it suggests silver's recent outperformance might moderate. For most investors, the right answer is holding both, weighted toward gold for stability and silver for growth potential. Let gold be your foundation and silver be your tactical position. One question that divides investors: are we facing inflation or deflation? Because the answer influences how you think about silver. In a true inflationary scenario, where currency purchasing power is declining rapidly, silver should perform well as a hard asset and store of value. It's one of the classic inflation hedges. In a deflationary scenario, where debt defaults, credit contracts, and demand collapses, most assets decline in nominal terms. Even silver would likely fall initially in such an environment, though it might outperform other assets. Here's my view, and you can disagree. We live in a world where deflation is politically intolerable to governments and central banks. Deflation makes debt burdens heavier in real terms. It rewards savers and punishes borrowers and speculators. It creates negative feedback loops in highly leveraged economies. Given the choice between deflation and inflation, between letting the system collapse or printing money to prevent that collapse, central banks will print. Every time. They've told us this explicitly. Therefore, even if we see deflationary pressures periodically, the policy response will be inflationary. We might oscillate, but the long-term direction is toward currency debasement. This is a fundamental reason to own hard assets, including silver, as part of a long-term portfolio strategy. But acknowledge the risk. If I'm wrong, if we somehow end up in a sustained deflationary collapse that authorities can't or won't counter with money printing, silver would likely underperform in the initial phase. This is why diversification and position sizing matter. No single view of the future should dominate your entire portfolio. We haven't discussed geopolitics much, but it's increasingly relevant to precious metals. The post-World War II global order, with the US dollar as reserve currency and American financial infrastructure at the center, is under stress. Not collapsing, but definitely under stress. China is building alternative payment systems. The BRICS nations are discussing alternative currency arrangements. Central banks globally have been net buyers of gold for years, diversifying away from pure dollar dependence. This doesn't mean the dollar will collapse next year. The dollar remains the most liquid, most trusted major currency, backed by the largest economy and strongest military. But at the margin, the move toward multipolarity, toward reduced dollar dominance, is real and ongoing. And this is constructive for precious metals as alternative stores of value and settlement mechanisms. Additionally, geopolitical tensions create safe haven demand for precious metals. When markets are uncertain about potential conflicts, sanctions, or systemic disruptions, investors seek assets that aren't tied to any single nation's promises. Silver benefits from this, though less directly than gold. But it's part of the backdrop supporting precious metals broadly. Let's examine the green energy angle specifically, because this is one of the unique factors supporting silver that wasn't present in previous bull markets. Solar panels require approximately 20 grams of silver per panel for the conductive paste. This is currently non-negotiable. No other material provides the necessary conductivity and efficiency at comparable cost. Global solar installations have been growing at double-digit rates annually. China, the US, Europe, and India are all massively expanding solar capacity. Corporate buyers are adding solar to meet sustainability commitments. The cost curve for solar has declined to the point where it's often the cheapest source of new electricity generation. This creates structural demand for silver that will persist for decades. Even if some silver gets recycled from old panels, the net consumption from the solar industry is substantial and growing. Add to that electric vehicles, which use more silver than traditional cars for their electrical systems. Add 5G infrastructure. Add the general electrification of everything. Silver's industrial demand profile is strong and getting stronger. This provides a floor under prices that didn't exist historically when silver was primarily a monetary metal. However, don't overweight this factor. Industrial demand is steady and predictable. It's not what drives major price moves. Those come from investment demand, from monetary concerns, from rapid shifts in sentiment and positioning. The industrial demand is the foundation. Investment demand is the multiplier. For those ready to take action, let's discuss practical execution. If you're buying physical silver, you'll typically pay a premium over spot price. This premium varies based on form, coins versus bars, quantity, dealer, and market conditions. In tight markets, premiums can spike significantly. Popular coins include American Silver Eagles, Canadian Maple Leafs, and Austrian Philharmonics. These carry higher premiums, but are also more liquid when you want to sell. Bars, especially larger bars, have lower premiums, but can be harder to sell in small quantities and may require assay when selling. Storage is a real consideration. Silver is bulky compared to gold. $10,000 of gold fits in your hand. $10,000 of silver is a substantial physical mass. If you're buying significant amounts, professional storage might make sense despite the cost. For ETFs, the largest is SLV, the iShares Silver Trust. It's liquid and tracks silver prices reasonably well. There are others, including some that hold physical silver in allocated form. Read the prospectus and understand the structure before buying. For futures, understand that you're trading contracts, not owning silver. Futures require active management, understanding of contract specifications, rollover dates, and margin requirements. They're tools for sophisticated traders, not casual investors. For mining stocks, do your homework. Look at production costs, reserve quality, management track record, jurisdictional risk. Diversify across multiple companies and understand you're taking company-specific risk on top of silver price risk. Whatever form you choose, document your purchases, including dates, prices, and premiums. You'll need this for tax purposes when you eventually sell. Let's address the psychological aspect directly, because this is where most wealth is won or lost. Markets are designed to inflict maximum psychological pain. They rise when pessimism is highest. They fall when optimism is highest. They shake you out right before major moves. Your emotions are not your friend in investing. Fear and greed will lead you to do the wrong thing at the wrong time, almost without exception. The solution is having a framework that's more powerful than your emotions. Rules, position sizing, predetermined entry and exit points. A plan made when you're calm that you execute when you're panicking or euphoric. This is not theory. This is the difference between success and failure in volatile markets. You will experience moments of doubt. Silver will drop 20%, and you'll wonder if you made a terrible mistake. It will then rally 30%, and you'll wish you'd bought more. Neither feeling should drive decisions. Your framework drives decisions. Your emotions are acknowledged, observed, and then set aside. This is mental discipline. This is what separates professionals from amateurs. Professionals feel the same emotions. They just don't act on them. If you can't develop this discipline, if you know you'll panic sell during corrections or FOMO buy during spikes, then you should either automate your investing through systematic accumulation or keep your positions small enough that the emotional impact is manageable. There's no shame in knowing your limitations. There's only shame in ignoring them and suffering predictable consequences. Let's contextualize silver within a complete financial plan. A properly constructed portfolio addresses multiple goals and risks: growth, income, capital preservation, inflation protection, deflation protection, liquidity needs, and tax efficiency. Silver addresses primarily three of these: inflation protection, growth potential during specific market environments, and diversification from traditional financial assets. It does not provide income. It does not provide deflation protection. Its liquidity can be limited if you own physical. Its tax treatment can be unfavorable. This means silver should be a component of your portfolio, not the foundation. Your foundation should be productive assets, businesses, real estate, your own earning power, things that produce cash flow and grow intrinsic value over time. Silver is a hedge, a speculation, a form of insurance, all valid, all potentially valuable, but not a replacement for the core of wealth building. For most people, somewhere between 5 and 15% in total precious metals, with perhaps a quarter to half of that specifically in silver, represents reasonable allocation. Enough to matter if precious metals perform, not so much that underperformance is devastating. Wealthier investors with higher risk tolerance might go higher. More conservative investors might go lower or skip precious metals entirely. The point is intentionality. Know what you're doing and why. Have a rationale that fits your complete financial picture. Let me address several questions I hear repeatedly. Is it too late to buy silver? Impossible to answer definitively, but consider, if we're truly in the early stages of a major precious metals bull market driven by currency debasement and sovereign debt crises, we could be years away from a top. If we're late in a speculative rally, we could see a reversal soon. The question isn't whether it's too late. The question is, what allocation makes sense for your situation, and are you prepared to hold through volatility? Should I buy silver instead of gold? For most investors, no. Gold should be the larger holding. Silver is the more aggressive, more volatile complement. What about platinum or palladium? These are primarily industrial metals with different supply-demand dynamics. They don't have silver's monetary properties. They're fine as commodity plays if you understand those markets, but they're not substitutes for silver's role in a portfolio. Should I tell people I own silver? Generally, no. Loose lips create security risks if you own physical. They also invite unwanted opinions and pressure to trade at inopportune times. How do I know if my dealer is reputable? Check industry associations, verify business history, read reviews carefully, start with small purchases, verify authenticity of product received. Better dealers charge slightly higher premiums but provide security and reliability. What if the government confiscates silver? Historically, gold faced confiscation risk during the 1930s. Silver was exempt. Could it happen again? Theoretically, but it's considered unlikely for several reasons. Still, diversification across jurisdictions and forms provides some mitigation if you're concerned about this tail risk. Markets evolve, conditions change. What's true today might not be true tomorrow. Your job as an investor isn't to make one decision and walk away. Your job is to monitor conditions, stay informed about relevant developments, and adjust your framework as appropriate. For silver, this means tracking several things: physical supply-demand data, central bank policies, sovereign debt levels, dollar strength, geopolitical developments, and technological changes affecting industrial demand. You don't need to track these daily, but quarterly reviews of the big picture ensure you're not caught off guard by major shifts. Subscribe to quality research, not hype-driven newsletters. Understand the difference between data and opinion. Develop multiple information sources so you're not dependent on any single perspective. And stay humble. The investors who blow up are the ones who become certain they know the future. The investors who prosper long-term are the ones who remain flexible, acknowledge uncertainty, and adjust as new information arrives. Zoom out for a moment. Beyond silver, beyond specific investments, what are we really talking about? We're talking about protecting and growing wealth in a time of systemic change. The financial system that's existed since World War II is transforming. The certainties of the past are less certain. The rules are being rewritten. This creates both dangers and opportunities. Dangers for those who remain complacent, assuming the future will look like the past. Opportunities for those who adapt, who think independently, who position themselves for multiple scenarios. Silver is one tool in the toolkit, an important one, potentially, but only one. Your real edge, your real source of security, is your ability to think clearly, stay disciplined, and adjust to changing conditions. That transcends any single investment. The world needs more investors who think this way, who can hold conviction without becoming dogmatic, who can take risk without gambling, who can stay calm when others panic. This is the professional mindset. This is what I'm trying to help you develop, beyond just understanding silver. We've covered a lot of ground. Let me synthesize this into clear action steps. First, determine if silver fits your financial plan. Does it address risks you're concerned about? Does it provide diversification you need? Does it align with your timeline and risk tolerance? If yes, decide your allocation. Start conservative. You can always add more. You can't easily undo overconcentration. Second, choose your form of ownership based on your priorities. Physical for security and zero counterparty risk. ETFs for liquidity and ease, perhaps a combination. Third, develop your accumulation plan. Systematic purchases over time if you're building a position. Predetermine entry points if you prefer to wait for pullbacks. Fourth, create your rules. When will you add to positions? When will you reduce? What would cause you to exit entirely? Write these down. Fifth, integrate silver into your broader portfolio monitoring. Review quarterly, adjust as needed, rebalance if allocation drifts too far from target. Sixth, commit to emotional discipline. Your framework, not your feelings, drives decisions. And finally, stay educated. Markets evolve. Your understanding should evolve with them. What's happening in silver right now is significant, not because of where price is today, but because of what the conditions suggest about the environment we're entering. We live in a time of monetary experimentation, debt saturation, and systemic uncertainty. These are precisely the conditions that have historically driven major moves in precious metals. Does that mean silver will definitely soar? No. Nothing is definite. Markets are probabilistic. But it means the risk-reward for having exposure is compelling. It means the cost of being wrong about not having any precious metals exposure is potentially higher than the cost of being wrong about having some. You don't need to bet everything on silver. You don't need to become a precious metals evangelist. You just need to think clearly about risks, position yourself sensibly, and maintain the discipline to see your plan through. That's the professional approach. That's how lasting wealth is built and protected. Everything I've shared with you today is designed to help you make better decisions. Not guaranteed to work decisions, because those don't exist, but better decisions, more informed decisions, decisions based on frameworks rather than emotions. The rest is up to you. You have the information. You have the frameworks. You understand the risks and the opportunities. Now you must decide. And in deciding, remember that the greatest risk in any market is not the risk of loss. It's the risk of letting fear paralyze you into inaction when action is warranted, but letting greed push you into recklessness when caution is required. Find the balance, stay disciplined, think long term, protect your capital first, seek gain second. This is the path to financial security in uncertain times. This is how you navigate what's coming, whatever that turns out to be. Silver has changed. The question is, how will you respond? Thank you for your time and attention. I hope this has been valuable. Until next time, stay informed, stay disciplined, and stay rational.